want to do is spend some time with you this evening going over some of the income tax law changes for 2013. We're getting closer and closer to the end of the year. April 15th will be here before you know it. So we do have an opportunity to make some changes between now and the end of the year so that hopefully you can minimize your tax bill. Some of the prior provisions that have been put back on the table, the itemized deduction limits over the last couple years, the IRS, they had relaxed that, and they did not have you have the limitation on itemizing your deductions. If you were a higher income earner, you were still able to take all of the deductions that you were entitled to. But they have recently put that back on the table to where you could potentially lose up to 80% of the deductions once you phase out. Your itemized deductions will be reduced by 3%, but it's at a certain threshold. So I don't want to scare you, because you're going to have to make quite a bit of money before that starts to impact you. That's one of the items that's been put back on the table. Personal exemptions phase out, that has been put back on the table the last couple years. If you pay close attention to your tax return, whatever your personal exemptions were, regardless of your income, you were able to deduct the entire amount. Now for higher income earners, that phase out is back into place, and you'll start losing 2% of $2,500 once you go over what the phase out limits are. And I have up here what the phase out limits are. If your adjusted gross income, and hopefully I'm not standing in the middle of this, if your adjusted gross income, if you're married filing a joint return, so you and your spouse together, you hit $300,000 in your adjusted gross income, these limits will start to kick in. So you'll start losing some of those deductions and the exemption. Head of household, $275,000. Married filing a separate return, $150,000, and single, $250,000. So you do have some room to make some money before you start losing the benefit of these tax deductions. The other item, the Social Security payroll taxes, we're already most of the way through the year, so if you haven't felt it, you now are paying the full rate that we were paying a couple years ago. Last year, you had a discount, so you should have seen that there was more money in your payroll check. In 2013, it went back to the old amount, so now we're all paying the full amount on the Social Security that comes out of your payroll checks. The inflationary adjustments that have been made, the standard mileage rate for this year is 56.5%, okay? One thing that I want to make sure that everyone is aware of, if you are taking the standard mileage, you should be maintaining a mileage log, okay? It can't all be up in your head, because if the IRS were to challenge you on that, you have to be able to produce the log. I want to give you a secret though. The IRS doesn't want you to really know this, but it's in the tax law. If your mileage is generally the same, so you're traveling the same in January as you are in February, March, April, May, you can keep a very detailed log of that 1 month that is representative of the full year, and you are allowed to extrapolate that throughout the year. So if you're ever challenged on the IRS, you need to at least, at a very bare bone minimum, be able to produce at least 1 month full mileage log so that we can get that mileage accepted by the IRS. So keep that in mind. Exemptions, the personal exemptions, $3,900 per person. So when those children get to the point where they think they're grown enough to file their own tax return, and they want to be taken off of your return for whatever reason because they worked at Schnucks and made $2,000 for the whole year, $3,900 is what you're giving up in exemption. So keep that in mind. The IRA deduction and the phase-offs have increased. You are able to put in $5,500, and if you're over 50, you can contribute up to $6,500. $100 on there. And the phase outs, if you are single, head of household, 59,000 to 69,000, and then you start phasing out the ability to take to make those contributions. Married filing a joint return, 95,000 to 115. Okay, the dependent standard deduction is $1,000, and what I think this is important for you to know when we have children who were used to carrying on our returns, but now they're working a summer job or an after-school job, so they made just a little bit of money to stay out of your pocket, so they had enough money to go to the movies. So they got a W-2.
Kids do that?
Oh yeah, kids do that. And then when the parents bring the tax return in and it get kicks out on the e-file because the kid already went somewhere and got their $2 back because they used their own exemption and causes all kinds of issues, it's important for you to know how much money we have sitting on the table for that child. $1,000 is what they get for their standard deduction. And you saw earlier, we have $3,900 for the personal exemption. So that's $4,900. If they made less than that, and actually if they made even a little bit more than that, grab that W-2. Do not let them file it on their own. We need to make sure we put that dependency on the proper tax return. So just be aware of what those numbers are. Other changes that have been put into place for 2013, and some of these have been modified and permanent. The individual tax rates, and we have the rates listed there, 10, 15, 25, 28, 33, 35%, and now the highest top tax rate is 39.6%. So almost 40%. So for every dollar you make and you keep on your bottom line, 40 cents of that you have to pay in taxes. In federal, yeah, that's only federal taxes. We haven't talked about state or city. So this is just federal. That's a lot of money in taxes. And I'm a tax preparer. I love doing taxes, but that's crazy money. But my job today is not to give a political commentary. It's just to explain to you the tax law changes. Long-term capital gain tax rate, 15%, which is great. On the high end is 20%. That 20% will only be applicable if you're in that 39.6. So wow, we just added, that's 39.6 plus 20% on top of that, that's a lot of money in taxes. The medical and dental deduction, it used to be at 7.5%. In 2013, they've increased it to 10%. So if it was not hard enough to get the deduction at 7.5%, you probably won't get it. But it's a good thing. You weren't so sick to where you were able to hit those numbers. So again, I'm not here for a political commentary, just to explain the tax law changes. Okay, now here is something you really want to be aware of. The net investment income tax, because this is brand new. This is going to catch a lot of people by surprise. This is a new tax. 3.8% additional tax that you'll have to pay on certain net investment income. Again, it'll only impact you if your modified adjusted gross income hits a certain level. And I have those here: married, filing, joint, or qualifying will, $250,000. And it's pretty easy for a husband and wife, two people working, a small business in the mix. If you have a good year, it's pretty easy to hit that. Single or head of household, $200,000, and married filing separate, $125,000. So if your modified adjusted gross income hits those numbers, expect to pay an additional 3.8% in taxes on certain investment income. Well, what's investment income? Your interest, your dividends, rental real estate. A lot of people are involved in that. Royalties, partnerships. So depending on how your small business is taxed, you may have that. S corporation. We're going to talk about that a little later. You know how that flows over to your personal return. And then gains and losses from property dispositions. So if your income, your modified adjusted gross income is approaching those numbers, and if you're not sure, pull out prior year's tax return and look on, if you look on the very first page of your 1040, look at the very last number. And if that number is approaching any of these, you want to contact your CPA and tell them, hey, we're in September, we need to do some tax planning before we get out of the year, and then April 15th, you have a huge tax bill. Additional Medicare tax, this is more taxes that we'll have to contend with. This is 0.9%, so they did keep it under 1%, so less than 1%, 0.9% of additional Medicare tax that you have to pay on your wages or any other compensation, as well as self-employment income, okay? The threshold again, if your income hits, if you're married filing a joint return, 200,000 or more, married filing separate 125, and everybody else, all the other filing statuses 200,000, you will be responsible for paying this 0.9% of additional Medicare tax. What's important for you to know about this, you should have that withheld off of your earnings, your W-2 money that you're getting throughout the year, okay? If you don't increase that, you should increase your estimated tax payments that you are making throughout the year. And we still have time, you could still get that third quarter in, and definitely we have time for that fourth quarter one. Just be aware of this. Another point I want to make on the additional Medicare tax from the employer standpoint, because you all are small business owners, you may have employees that this is going to impact you. You must withhold that 0.9% of additional Medicare tax on any wages that you're paying to any of your people if they're going to hit 200,000 or more. Regardless of what their personal tax filing status, whether they're married filing joint, married filing separate, or whatever, if they are making $200,000 or more from you as their employer, the IRS requires that you withhold that 0.9%. There is no employer match. On the regular Medicare, we have to do the match, but there is no match on this. On the 941, which hopefully, as Jeffrey mentioned earlier, those payroll taxes, that's a monster. You don't want to get on the wrong side of those payroll taxes. That trust fund recovery penalty will kill you. So hopefully you're not the one doing your own payroll. Hopefully you've entrusted that to your accountant to handle. But on the 941, there is a line on there where you have to report that additional 0.9% that you're taking out. And it is reported on the W-2s, okay? Business use of home, the IRS, they are a friendlier, gentler IRS, so they say. So they have simplified the home office deduction. What I think they've done, they couldn't audit everybody, and they knew a whole bunch of people had home office deductions on those tax returns that probably were not valid, so this is their attempt to fix that as best they can. There's a safe harbor method now where the IRS, no questions asked, as long as you do legitimately have a home office that you're using. Maximum square footage, 300 square feet. A flat deduction of $5 per square feet. You don't have to measure it. You don't have to do anything. So you're automatically going to be entitled to a $1,500 home office deduction. No substantiation. So you don't have to keep track of all of the utilities and all of that. Just by the nature of you having a home office, you'll be entitled to this $1,500 now. Okay? It is limited to the gross income. So if you had $1,500 of gross income, and you can take the $1,500 of the office deduction. So it is limited to that. If you had a loss, you can't get it because it's limited to what the income is. And it cannot be carried forward. Okay, so you get to use it this year or it's gone. That 8829 form, which that's the form that your tax preparer has been putting in your tax return anytime you take the home office deduction, you're no longer required to include that if you use this safe harbor method. You can, however, still do it the old way. So if $1,500 is laughable to you for a home office deduction and you need $6,000 in home office deduction, you can still keep all of your substantiation, complete the 8829 tax form, and then take whatever your actual amount is. And that amount still gets carried over as well. And one other thing I will point out, and then I'll take the 2 questions. The IRS will allow you to go back and forth. So this year, you may say you're going to do the safe harbor. Next year, oh, that wasn't enough. I think I have more. So next year, you can change it. The IRS will allow you to go back and forth. The IRS tax code requires that you are using space exclusively to operate that business. And that is your primary place where you're operating that business. So it has to be exclusive. Now, once you interject something else in that space, it's no longer exclusive and you're no longer entitled to the home office deduction. That's the information I wanted to share with you on some of the new tax law changes that will come into effect. Like I said, we're already in September. So some of the other items which I'm going to assume you know, but I'll just reiterate them. These are the things that you want to do every year in your business. If we have a lot of money still sitting on the bottom line, a lot of net income, now is the time to figure out, do we need to invest in any fixed assets? Do we need new computers? Do we need a new truck? What large dollar expenditures do we want to consider so that we can get some Section 179 or some special depreciation so that we can lower the tax bill, delay any revenue that we can into 2014 so we don't have to worry about the taxability of that right now in 2013. And one thing I want to reiterate, please clean up your accounting records before the end of the year. I love what Jeffrey said. Don't wait until March to think, ooh, it's time for me to get my taxes done and I don't have any accounting records. Clean those up now so that you can write off whatever stuff is not good so that you can have a good, clean set of accounting records. Now, I know that doesn't apply to anybody in here because obviously you're very conscious about operating your business or you wouldn't be here. But clean those up. There's money left over. Consider paying yourself a bonus. Consider paying your people a bonus. You might as well give the money to the people who are helping you further and grow your business as long as they're well deserving, as opposed to leaving that on the bottom line and sending it to Uncle Sam. Because now we have a tax deduction for that additional payroll. Retirement plans, we've already missed one of the deadlines, but you still have a December deadline to get some of the retirement plans at least established. And you have until April 15th to actually fund some of them and still get the tax deduction. So you want to make sure you are having those conversations with your CPA, your tax preparer, your financial planner, so that you can take advantage of those tax deductions. Okay? And if my firm can be of assistance to any of you, please let us know. I believe our contact information is in your packet. If you need a business card, we have those available for you as well.